Welcome. Thanks for joining us today. This is a webinar in support of our 2024 Target Setting Toolkit. My name is James Harris. I'm the Managing Director in B&M's Exec Comp practice, and I'm joined today by Alex Gardner, a Senior Director in the team. As I say, it's in support of the 2024, which is the second edition of our Target Setting Toolkit. If you follow the QR code there, you'll be able to get a copy of the report if you don't have one already. It's a really interesting piece of work. It's focused on performance targets for profit-based metrics in incentive plans across the FTSE. So very, very focused on targets. It's not about content, it's not about performance metrics, it's just around performance targets, which we think is a really interesting area, perhaps understudied in the market, and of course a really important thing because it's ultimately what determines what comes out under incentive plans. So we think it's pretty distinctive. We're very excited about it, and we're going to talk you through that today. We'll talk through the market data. I'll go first on the bonus, then Alex will pick up on the LTIP. Everything is from our database on performance targets drawn from across the FTSE up to year ends, including up to 30th of June 2023. We'll have scope for Q&A during the session and at the end. If you'd like to ask a question, there are two ways to do it. You can either do it in the chat, typical Teams chat, which is public and everyone can see. If you'd like to address a question anonymously, just Alex and myself, you can do that via the Q&A function, I believe, and that will come just for the two of us. So please do feel free to ask as we go, and as I say, we'll leave some scope at the end. We will also, just to let you know, we'll be recording the session and we'll be sending that along with the slides out to the participant group afterwards. So let's kick off. So we're going to be talking today about performance targets and how should market data on performance targets be used within the target setting process. It's kind of the irony of this session. We're going to talk a lot about market data, but actually it probably has a relatively minor role in target setting, and it should be used with caution, like any market data around quantum or structure of remuneration. You always need to carefully use it. In the report, we talk about what we believe to be a high quality, effective target setting process, which is how you use your internal plan, which should be the primary reference point for target setting in order to do so. And a high quality sequencing of target setting, which is to start with the board to ensure that sequencing is correct. Start with the board being the correct forum to scrutinize the plan, challenge the plan and test it, think about upside and downside risks, think about alignment to market expectations, and come out of the board with a plan, an annual budget for your annual plan, or a long-term plan for your LTIP, and ideally with a shared understanding in the business around the degree of stretch in that plan, ideally with some views around what exceptional, what above plan would look like, what below plan would look like. And then that goes to the remuneration committee, where you don't really want to be restarting conversations around what good and bad looks like. Ideally that comes down from the board and from the plan, and then the REMCO is tasked with using its judgment to set a performance range. And there are lots of things, lots of factors that the REMCO might want to think about alongside the plan. They might want to look at historic performance. They might want to look at the different stakeholder perspectives of shareholders, but equally the management team and what their experience has been. They might want to think about the degree of opportunity, how stretching the targets need to be in that context, various other factors that they want to look at. And of course, it's reasonable of the REMCO to say, well, with some of these aspects of calibration, what do other companies do? And that's where I think the market data would come in. So you then might say, what about the width of the range? How symmetrical should it be? How should we calibrate our performance targets for our LTIP? very reasonable questions, and the market data is useful in supporting that. But as I say, it's not going to give you the answer. So it will often be the case that what is right for one company is obviously not necessarily right for others. What's right for across the market might not be right for your business. And so we always see the market data here as a sense check, secondary to your internal plans, your internal reference points, but nevertheless a useful one. So with that, we will crack on to have a look at some market data. And as I say, we'll start with the bonus. I'll go first on the bonus, then Alex will come in on the LTIP. So first of all, pretty straightforward. How do companies structure the payout range for an annual bonus? Still very, very common. 78%, so nearly 4 out of 5 companies are using a 3-point schedule, conventional 3-point schedule, a target, and then a threshold below that, and then a maximum above that. A minority are using a 2-point schedule, so most commonly a threshold to maximum, kind of like a conventional LTIP. And there's always the challenge that some companies may be using 3 points but only disclosing 2, which obviously we can't tell from the data. And then we came across a handful of very slightly strange examples of companies who decided not to even use a threshold, but to say they were just using a target and a maximum, which we thought was unusual but interesting, and literally only a handful of those. What pays out for threshold? Often a question that gets asked, and this chart shows the full range of practice. So every single line on this chart is a different company across the FTSE, and the payouts as a percentage of maximum for achieving threshold performance. And what's interesting about this, that the median would actually be 20% of maximum, but most companies are either using 25% or 0%. So at the left-hand side of this chart, these are actually zeros. These companies where there's nothing shown, they would each be a company paying out 0. So that's the structure of the profit payout curve. Then we get into how the range is calibrated, and we're talking here about the width of the range. So what we mean by that is the extent to which the maximum profit target exceeds the target, and the extent to which the threshold target is below the target. So this chart, the chart that we show there is the FTSE 100. Again, each bar is one company. If you look at towards the left-hand side, a lot of these are plus or minus 5 around target. So that would mean your maximum is 5% above your target. Your threshold is 5% below your target. And what you can see is there's a wide range of practice, as you would expect, because it depends on the circumstances and characteristics of the business. So, probably most relevant, the degree of uncertainty, the degree of or lack of predictability in the business would likely cause you to have a wider range, all else equal. The other thing we can observe is that the range is typically wider in smaller companies. So in the tables on the right-hand side, we show the 250 and the small cap. In the FTSE 100, the median is 5%, plus or minus 5%. In the 250 small cap, more likely to be 10%. Again, reflecting the types of businesses as you go sort of smaller market cap across the market. So how about the trends in the width of ranges? So this is comparing the width of range in our sample, which is up to 30th of June 2023, with the width of range for that same company in the prior year. And what we can see here is that around about half of the market tended to use the same width of range year on year, but around about half tended to change the width of their range. And in those that changed, it was more common to narrow the range year on year. So maybe last year they were using plus or minus 10, and then they were using plus or minus 8 in our period here, something like that. So that's just the general trend. So if you look at the FTSE 100, 37% narrowed only 18% increased the width of the range, which obviously there'll be changes year on year in any year. I think this trend we would attribute to, in this sample, ranges being wider the year before as companies were responding to COVID in that year and the uncertainty around COVID. And then this year they narrowed because they thought we're maybe back to a bit more of a business as usual type year. So there was a slight trend towards narrowing of ranges. So then we get onto this question of symmetry. So you'll have seen on the previous charts that it's fairly common to use a symmetrical range. So by which we mean, as shown there in these illustrative charts at the top, maybe you do plus the same percentage on the top and the bottom. So plus or minus 10 or plus or minus 5. But of course, it's possible to have a skewed performance range around the target. So for example, you might skew the range more to the upside if your risks around your budget, your risks around target are to the upside. So you might have minus 10 plus 20, that would be skewed towards the maximum. And there are various reasons you might do this, but let's say your target is very, very stretching, you don't see much opportunity to go beyond that, or perhaps your risks are to the downside, then maybe you would skew towards the threshold. So you might have plus 10 to max and minus 20 to the threshold, just illustrative numbers. And what the market data shows is that, yes, symmetrical ranges are the most common. They typically are in around about half of the market. We show it there, 100, 250 in small cap. But skewed ranges are seen in the market, often around about half. They tend to be split equally between those skewed to the maximum and skewed to the threshold, except for in the small cap where they're often more skewed to the maximum. And we think this is often something which people find surprising. And I think perhaps there's been more movement to using these kind of skewed ranges over the years. I think many years ago it was much more common. You just say, let's have a symmetrical range because of course we have to have symmetry. So interesting data point, that one. Okay, and then we're going to talk about the growth in the implied level of growth in the profit ranges. So if you think about bonus targets, they are most commonly disclosed as a pound value, an absolute pound value. Of course, what we can do is calculate an implied growth rate for each point in the range, the threshold, the target, and the maximum, from the prior year actual, so that it's more easy to compare percentages across companies and across the market. So we have to note the caveats and the assumptions that apply to this. So obviously, when we are trying to calculate a percentage growth from a prior year, it's not always possible necessarily to have a like-for-like comparison, because as you'll know, there are adjustments that are made to bonuses for M&A or for currency or for other types of adjustments that make it challenging to have a like-for-like comparison with the prior year, certainly on the basis of public data which we are using. But nevertheless, it's interesting to see. The chart here, again, let's look at the FTSE 100 chart. We're showing each bar is one company, and it's the range of implied growth from threshold to maximum. Those little yellow dots within the bars, that's the target. And what can we see? Again, there's a range of practice, again, as you would expect, dependent on the company, the sector, and its circumstances. And I think this is a great chart to illustrate the point about just using this as a sense check. So, if you were to say, well, the median percentage growth for target payout in the FTSE 100 was 7%, which it was. So let's do 7% as well. But if you were a business that was expected to deliver 15 or 20% growth in that year, it's clearly not a relevant benchmark. And equally, if you were expected to deliver sort of 3% or 2%, it will be very challenging. So it's definitely to be used as a sense check and to be considered carefully. Or, of course, the other thing you can do is take a more relevant cut. So a cut of your peers or your sector or something which is or could be considered a more relevant reference point. The The other thing we can observe here is that, similar on the width, that the level of growth is higher in smaller companies. So the median percent growth or maximum payout was 10% in the FTSE 100, 14% in the 250, and 18% in the small cap. So useful reference point as long as it's sort of used with caution. Right. So this is analysis, new analysis in this year's report around the relativity of the target ranges to consensus, by which we mean the average, the mean or the median sell side analyst estimate for profit performance, which is, as you'll know, is often a really important reference point for boards, for remuneration committees, when thinking about how to calibrate the targets. So again, this one is not straightforward, and we have to really think about the caveat to this. So the way we have done this is, as we talked about on the previous page, we've calculated implied growth percentages in target ranges across the market. And then what we can do is calculate for a similar metric, assuming a sort of reasonable point in time at which the consensus would have been relevant, sort of 2 months into the financial year. We calculate what the implied growth rate in the consensus data was, and then we can compare that with our target ranges to see what would have paid out under those targets for the delivery of that consensus growth rate. And then we plot that on the chart. So this is across the FTSE, the amount that would pay out for delivering consensus. Again, each bar is one company. And, you know, I mentioned the caveats to the implied growth rate data. Obviously, with layering on the consensus, you've got even more caveats that, you know, consensus isn't always necessarily robust. It's we might have a slight mismatch in metrics. We've done as best we can to match up metrics, but it might not be perfect. And of course, the timing at which the consensus is taken might be different in different companies. So you've got to treat this with a pinch of salt, but nevertheless, really interesting analysis. And what it shows is that around 3/4 of the market position the consensus within the target range, which is, I guess, what you would expect to see. Interesting to note that there are reasonable minority there on the right-hand side that position the target range below consensus. So if you deliver consensus, you get 100% payout, which I'm not sure shareholders would typically be thrilled about. One of the things we did test there was, you know, does that mean those targets were softer than they might have been, or does it just mean that there's a problem with the methodology and, you know, that maybe the consensus is not right for those companies? And what we did find is that the level of payout in that group did tend to be higher than it was in the market as a whole, which does sort of suggest that perhaps those targets were slightly softer than they otherwise might have been. But nevertheless, most companies within the range of practice within there about exactly where you would position it. The median across there is about 64, so around 60% is the kind of median. So we think this is a really interesting, again, sense check on where you'd be positioning your target range relative to consensus. But just think about the caveats and the assumptions that we've used there. Okay, and finally, we thought we would look at the level of payout as well. So again, this is a reference point that Remuneration Committee might be interested to ask. You know, how much do these bonuses typically pay out across the market? So we've looked at average payouts, and the way we've done this is not to focus just on one particular year, because that can be subject to volatility. If you think back to the COVID year, they were bonuses way down, and after that they kind of rebounded. This is a 5-year average. So we're sort of saying, look, what can be expected to pay out on average over time across the market? We divide up those or categorize those levels of payout into the 5 categories you see there. And what you can see is it's about 1 in 4 that would be expected to either max out or be very, very close to max, kind of above 90%. And around 15% you get 0. I think that's probably slightly inflated by including a COVID year in here. Probably on average, a 0 bonus is probably maybe slightly lower than that. But most companies are in that range around the 60s. I think you typically expect to get something, around the target or slightly above the target. I think the median 65%. So again, just another useful reference point when thinking about how to calibrate your ranges. And with that, I will hand over to Alex to pick up the LTIP analysis.
Excellent. Thank you, James. So now moving on to the LTIP. And so here we're looking at 3-year profit targets in performance share plans. And different to the bonus, which is, backward looking, the disclosure that companies will give you is what happened in the year just gone. This will be pretty much the most recent LTIP award. So it's more forward looking at the data that we're seeing here. All right. Now, so comparing this to bonus, when companies are setting targets, whereas in bonus, they usually set a threshold target and maximum, as James described. For LTIPs, we usually see 2 points. So just a threshold and maximum, as you can see on the chart on the left there. And that is very much market practice. 83% of companies do that. However, a significant minority might also set a 3rd point, usually a target in the middle of the range there somewhere. And if you were to hop across the Atlantic to America, that would actually be majority market practice, and also in Europe. But here on the London Stock Exchange, 2 points, threshold and maximum, is what we see. Now, obviously, if you hit your maximum target, you're getting everything, all the shares under award. What do you get if you hit your threshold? Well, the most common vesting percentage for threshold is 25%. And on the chart on the right there, you can see that about 2/3 of the market will deliver a 25% vesting outcome for hitting the threshold. Now that tends to be, some of these companies do have lower amounts. So you can see 32% have lower, and that tends to be at some of the larger companies because they're taking into account the how much vests at threshold relative to base salary. The investors and the IA don't typically like it if you are delivering a large payout at threshold relative to your salary. So if you're a large company, you have a larger reward, so you set a lower percentage at threshold so that it looks a bit more fair versus your salary. Anyway, if we could then go on to the next slide, James. Thanks. All right, so how do companies set their targets? Now, on the left there, we have the 4 most common ways the targets are set. Now, in the dark blue, or slightly dark blue, we've got a percentage growth, and then in the gray, absolute pence. These are the 2 most common ways, and just to go over them quickly, percentage growth is where you set a target range such as 5% per annum for threshold, 15% per annum growth for stretch, and at the end of your 3-year period, you see how you've done and compare against that range. Pence is simply you say, all right, maybe 10p at threshold, 15p at max. Now, within those 2, there is some variation. So within the percentage growth, the light blue there is something that used to be more common in the past, less common now, where you set relative to a benchmark, typically maybe RPI in the past, maybe now CPI if you don't like RPI so much. And even if you want to be very innovative, you could look at an industrial benchmark or GDP, which we've seen some companies do, but most tend to be against RPI and CPI. And even after that lengthy explanation, if you look on the chart on the right there, you'll see not many companies have been doing this. And in fact, those small percentages there are actually reduced year on year, as the general trend we have seen is, well, for a while now, away from these relative measures and towards actually pence targets in the grey. And now the final one is the absolute pence cumulative approach. Now, this is actually quite consistent, but between the FTSE 100, 250 and small cap. And in this one, you would set a target for the sum of EPS over the entire performance period. So if you've got a 3-year performance period, you get your EPS in year 1, EPS in year 2, and in year 3, add it together, see what the outcome is, and then you set targets for that. Now, why would you want to do that? Well, it has the benefit of, the timing of profits is not important, right? So this is one of the reasons you might do it, but it has the drawback that if in year 1 or year 2 you get a very bad outcome, then that can wipe you out entirely, and you end up getting nothing. So, and that is pretty consistent across the 100, 250 and small cap at around 10%, and not changed much year on year either. So, James, could we go on to the next slide? Fantastic. So now we've got the growth in profit ranges. So this is similar to the slide James showed for the annual bonus. And what we've shown here, so the example there for the FTSE 100 is 1 bar per company. If they set a EPS percentage growth target range, then that's pretty easy to put to put on this chart. You just get the percentages and pop it on here. Whereas if they've sent a pence target, we then have to get the base year for that award and convert it into an equivalent percentage per annum to make it comparable. And a lot of the companies you see on that chart, which have, for example, to the far left there, negative growth rates, they are going to be the companies which set pence targets, because typically in your annual report you don't want to say we're going to be growing at threshold target from -5 to -1 or something. So those are the ones there. Now, what do we see? As with bonus, a range of practice, because like all of this, and James mentioned as well, these are all useful reference points as a sense check. And the main thing that has to drive where you're setting your targets here is, what do you think the profit trajectory for your business is going to be? So range of practice, can do a sector cut of this data as well, but we do see generally higher levels of growth in smaller companies, and in particular the small cap. And in terms of year-on-year change, I'd say there's been maybe a slight, well, it varies between the indices, but broadly unchanged, 1% here and there. But I don't think that's a significant enough change to talk much about. Anyway, on to the next one, if that's all right.
I think just on this one, Alex, I think one of the things I found interesting and sort of had to go and double check the data is that the threshold, the growth rate for threshold at median is the same in the 100, 250 and small cap at 5%. Suggesting that there's a sort of reasonable agreed sort of market level of growth which should start triggering payouts. But then it's the upper end of the range is the maximum end, which tends to be higher in the smaller companies, which I thought was quite interesting. I'll move you on that. There you go.
So on to the consensus. So same chart and same approach as with the bonus, where what we're looking at is at the point of grant, at the point that when targets were set, where was the target range relative to consensus? And if you met consensus, what level of payout would you get? So this chart shows 1 bar for each company. On the far right, the dark blue lines there, those companies would have set their targets so that if they met consensus, they get a maximum payout. And the ones in the middle, if they met consensus, would be somewhere in the payout range. And then on the far left, if they met consensus, they would get nothing. Right? Now, this data has a number of warnings. And if you remember James's chart, there was one warning on here, and here we're upping the warnings even more because all the same, let's say, caveats to do with the bonus apply here. You know, we've got to match the profit measure. There's always the, the difficulty and matching consensus. And also some companies, if you look far out in 3 years, they won't have that many brokers following them. So we also have to make some adjustments for that. And a bit like my experience of weather forecasts, you know, one day forecasts are better than 5-day forecasts. And it's the same with 1-year forecasts and 3-year forecasts. You know, here we're looking at 3-year forecasts. It's just not as reliable. So after having said, you know, all of that, what do we find? Well, we find that about 60% of the companies positioned consensus somewhere in the target range. So if you hit consensus, you'd get somewhere, you know, in between the threshold payout level, which, as we said, is typically around 25%, and somewhere between max, which is, you know, obviously everything. This is less than what you see for bonus, which I think was about 75%, but still the majority. Now, one reason why this could be, and you know, this is my hypothesis, is that LTIP target ranges, well, in particular, the percentage growth target ranges tend to be a little bit more sticky, by which I mean they're less likely to change year on year. You know, your bonus, you're going to be changing it every year based on where you think your budget is and, you know, your outlook for the next year. For your LTIP, the long-term strategic growth goals are less variable. So, and also companies in our experience, I think, tend to be, you know, they don't like moving those forward-looking growth targets around because of the potential message that it sends to the market. So what does this mean? Well, you've set, I don't know, 5 to 15% per annum LTIP growth range. Consensus might move about for, you know, year on year, but you're less likely to move your target range around, so which might result in fewer companies having consensus positioned in the range. And anything you want to add to that, James, on that?
No, I don't think so. It's just to be aware of the caveats on this one. I mean, everyone, you know, will know that challenge of how do you get a reliable and a robust 3-year estimate. It's very difficult. And sometimes you look at a 2-year and then they will drop off in the 3-year. So it is, and we have made some adjustments for that, Alex, haven't we? In that, and we have also excluded sort of the ridiculous outliers where there was clearly a problem with the consensus. So this is within what we think is a, you know, reasonable estimates and a reasonable methodology. And I think you're probably, it's just that point that the 3-year is likely to be a bit more volatile than the 1-year analyst estimates, that is to have maybe fewer in the range. But broadly speaking, it's a sort of similar picture than you get for the bonus. You know, that roughly on average, it's about you're in that sort of 60% vesting level for hitting consensus. So,
which is also, I'd say, similar to what we would see at you know, if we were, you know, remuneration committee meetings, if they're trying to get the range and the consent, you know, they are usually trying to match those two up. But it's interesting to see the data support that in some way. But anyway, on to the next one. So here we are, so as with bonus, we're trying to get an idea of the long run sort of average level of vesting. So we've looked at 5 years worth of data, and this is what we've come up with. And so we get about 1 around 4 of LTIPs vest around max. And then 1/4, so about the same, receive 0 vesting. This is more than what we see for the annual bonus, and is it's kind of what we'd expect as well. And the average level is around 50%, which is lower than what we would see for the bonus as well. But not it's I don't think average level around 50 is for this year is what it's probably a little bit lower than what I would have expected. But I don't know what your thoughts on that, James.
No, I think that's it. I think the higher probability of a 0 compared to a bonus, and a non-negligible chance of a 0. I think which accord with most people's sort of anecdotal experience of LTIPs, and a slightly lower level of average typical vesting, 40, 50, 60 rather than sort of 60, 70, 80 under the bonus. So yeah,
that's it. So that is it for LTIPs.
Okay, so we've actually rattled through that fairly quickly, Alex, which is good because on our NED webinar we came up short on time, didn't we? So we've got plenty of time for questions. I don't know whether any have come in, Alex.
Let me have a quick check.
If you do have questions, you can put them in the chat, which is the public Teams chat, or you can use the Q&A function at the top, I believe, to submit a question to myself and Alex.
So first questioning, we do have one question in the Q&A. So this is, what do you typically see and what are shareholder expectations in terms of target and width of ranges for companies that are coming off a few years of high growth and expect to flatten out? Little to no growth budgeted over prior year.
Yeah, and I think that can be a really challenging situation. I mean, one of the things I've experienced there is it's really important. We talk about good process. So we spoke earlier around, right at the start, around high quality process. When you get to the remuneration committee, one of the things I've seen which has caught companies out is too much just rolling forward the prior year targets without any thought. So it's kind of as Alex explained, you have a range 5% to 15%. That's what we did last year. That's what we did the year before. Let's do that again. That seems fine. And if you're not really thinking through how the ranges relate to your budget and your plan, that is going to catch you out, and you're suddenly going to find you're a couple of years in and all your LTIPs are trending downwards and you haven't really adjusted them properly. So a good process to say, and this is the key to it, is the board needs to agree what the plan looks like. If it's a slowing down of growth, that will be in the plan numbers, and then that will be used by the Remco to set the ranges, and that might mean they start to come down. And then of course that needs to accord with the message that you're giving to the market around the prospects for the business. So it's no good the board saying, well, we're coming down, we're dropping from 20%, 10%, this is a slowing business. But if that doesn't accord with the messaging that IR and your team are giving to the market, it's much more challenging for the committee to set reasonable targets. So I think just making sure you have a good process and good and consistent communication around that messaging with the market is the way to deal with that. And I think as long as that's transparent with investors, as long as it's transparent with the messaging around where the growth prospects are going, as it's transparent with the consensus and managing that down to align with where the plan sits, then that's going to help the messaging. It's only when you get a disconnect between those two that you're going to run into problems, because there'll be this inconsistency with how you're trying to pay the executives and what investors think they're investing in. If that makes sense. Any other questions?
We've got one more question. So the question is, I appreciate why you're focused on profit EPS measures in your presentation, but can you give us any thoughts as to whether a similar approach tends to apply for other financial measures, or whether perhaps some other targets, such as cash ones, tend to have larger ranges?
Yes, we can. So I mean, look, I think that the process that we spoke about should apply to any metric, and that's as I just sort of mentioned then, the sequencing of board agreeing plan, agreeing shared understanding of, first of all, what the metrics best reflect that plan and that strategy, and then what the expectations for performance are, and upside and downside risks. That should all apply to any metric. interestingly, on the different metrics, if you look in last year's report, so the 2023 target setting toolkit, one of the pieces of analysis we did then, which we didn't repeat this year, but it is in 2023's report, was to look at the width of ranges for different metrics relative to profit. So we looked at two. We looked at revenue and cash flow. So on revenue, what we found is it's much more common for the revenue range to be more narrow than the profit range. And as you would expect, there are more factors influencing profit further down the P&L. First of all, you're bringing in costs than there are influencing revenue. So where a company had, might have a plus or minus 5, for example, profit width, it might have plus or minus 2, plus or minus 3 for revenue. That's very common. And then equally on cash flow, we found that it was much more common for the cash flow range to be wider than the profit range. So if you have plus or minus 10 on profit, you might have plus or minus 15 or 20 on cash flow, because cash flow is likely to be normally a bit more volatile, lumpy than profit might be. So to just give yourself a bit more leeway for it to underperform or outperform the budget. So those numbers, if you're interested in the exact percentages, I think we have them by FTSE 100, 250 small cap. They are in the 2023 report.
So another question here, James. Doesn't the payout chart, the payout chart for the LTIP show how difficult it is to set targets, particularly in these turbulent times? Shouldn't we be considering alternatives to LTIPs? What else might be considered?
Yes, I think it does. I mean, I think that you would expect to have some variation in incentive payouts as a natural consequence of it being variable pay. So you're not going to want this to always be, well, it should be target, it should be max all the time. You'd expect something like this. I think if you're consistently in the place where you're hitting a 0, then yes, perhaps well, it might be that the business isn't performing, but it could be that it is just too challenging to set targets. I mean, the obvious one here is that you would move to restricted shares instead of an LTIP, so that you could get some certainty in vesting levels. If you have just so much uncertainty and lack of visibility that you cannot set reasonable targets. I think if when you end up in one of these buckets, it feels almost random or sort of arbitrary, or where you were taken by the sort of forces that applied to the business and there was really no control over it, then you might be looking at restricted shares, which is it's a different discussion. You need to think about, you have the reduction in the upside opportunity. Is that acceptable? You have to think about whether you've got a strategic rationale, which you probably would have if you have that kind of such lack of visibility, but you'd be able to build a case with your shareholders for moving to restricted shares. And then I think one of the most interesting themes in the market now and over the last 6 to 12 months has been the growing interest in exploring hybrids. So by that, I mean you would combine restricted shares with some element of restricted shares with some element of performance shares, LTIP, so that you don't have to move completely to restricted shares. You can retain some element which is performance linked and some element which has more upside, but you give yourself an element of it which is effectively guaranteed for lock-in and retention purposes, and you get the best of both those types of models. So we think that that's an area which investors are becoming potentially more amenable to, and there's a lot of interest in the market. So I think sort of a watching brief on that as another option as well. I suppose the other option is that you say we can't set financial targets. It's too challenging, lack of visibility, but we'd like to stay performance related. So you could think there about something around the share price. So share options, that sort of thing that are, are going to stay very linked. The reward that management receive very linked to performance. It's just that it will be reflected in the share price and not in EPS or revenue or cash flow targets if they're too challenging to set.
So on those different structures you mentioned, like hybrid and restricted shares, and I guess it kind of feeds into a question. Another one we've got is there anything you can share on your perspectives on ways in which PLCs may need to change their thinking around bonus LTIP structures, to compete for international talent, whilst balancing the views of investors? So very much figures, goes into the current discussions that are going on, right, as well. So.
Yeah, I think we're definitely off topic. I think that one. I think the hybrid one is probably the big one in terms of structure and target setting that is likely to be a really big theme going forward. I think more companies are going to want to look at that. I mean, clearly, if you're looking to compete in the US market, then the quantum is the piece that you need to look at, which isn't really around structure or metrics or target setting. Again, I think there's maybe some growing theme amongst the investment community of acknowledging that this is an issue, and I think we think it's going to come down to ensuring that you have a genuinely compelling commercial case for increasing quantum, maybe not exactly to, but closer to US or global levels of pay, and being clear in your disclosure around that, and building a really compelling case that investors can sort of agree to, rather than just feel like the company is being sort of opportunistic and looking to increase quantum where that perhaps there isn't the commercial talent market need. So I think that's it. The other one I wonder about in the US structure is the one you touched on, Alex, which is perhaps more companies might move to this the LTIP approach, mirroring more the bonus approach, so having the target point in there. I mean, we said, I think we're up to, I think it's 17% having that at the moment, and that was pretty flat year on year. But it could be something that companies start to look towards if they want to more closely mirror what the US market is doing on LTIPs.
Yeah. But it would also then be interesting to know what the US market, how it sets, if there are any differences in the way it sets its targets and what payouts typically look like. Because when we have looked at that for some of our clients, we actually find them to be typically a little bit more, let's say, sticky to target, right? There is some variation, but not necessarily as much as you might see in London and the UK. So that's can't have your cake and eat it, right? Have the US incentive levels and expect to have maximum payout levels that's as often as you might see in the UK. But anyway, okay, taking it a bit back to target setting though, we have a question about, so slightly related, it's underpins. All right, is there so if you were considering an EBITDA underpin, all right, for an award which currently doesn't have anything, is there any way in which are there any special considerations you should be taking into account, or how would you set the target for that, taking into account the information we have here, perhaps?
Yeah, so obviously depends exactly what is meant by an underpin. I think you will find underpins on restricted shares awards. So investors are comfortable that restricted shares don't have performance targets in the conventional sense, in the sort of stretching sense, but they want to see that there are some, as they call them, underpins that provide a safeguard against payments for failure. So that's one way you could have an underpin. You can also have underpins in they're called different things, an underpin or a gateway or a threshold in a bonus plan, where you want to say, okay, well, we've got some of our bonus based on sales revenue, might not be profitable. We've got ESG, we've got other non-financial metrics. How do we ensure that we don't pay out on those range of metrics in a year where the profit performance doesn't justify it. It's not affordable. It doesn't support a bonus payment. So you might have an underpin or a similar type of thing there. And I think it's a similar thought process that you would go through for both. It's quite challenging, actually. And I talk about this mainly from the perspective of restricted shares, in that the market is used to saying, what does good look like? What does exceptional look like? That's how we think about where we should set our EPS targets. When you're looking at an underpin, it's almost the other way around, and you're trying to say, what does poor look like? How can we quantify the level of performance we need to drop to where we would find it uncomfortable paying out? And I think one of the trends we've seen on restricted share underpins, and this applies also to annual bonus underpins, I think, or it's certainly reflective of the range of types of approach you can take. One of the trends we've seen is a switch away from a hard underpin, to where you might say, okay, the EBITDA in 3 years under these restricted shares needs to be X million, to just a softer, more discretionary underpin that says, we have discretion, the committee has discretion to adjust the awards in the event that performance falls too far short of expectations. We will look at the following types of metrics: EBITDA, the broader performance of the business. And it's not a hard set in stone underpin, it's more of a discretionary approach. And there's definitely been a trend towards that on restricted shares. I think with a bonus, you just get a range of types of approach. I've definitely seen those companies that say, okay, it's you've got to hit the threshold profit range for anything to pay out. That can be quite tough. Or those that do it on a more discretionary basis, as I just described. So those are things I'd be thinking about for underpins.
So, and just as the very last one, we don't have any other questions at the moment, but going back to the first question about companies which have a few years of high growth and expect to flatten out, and little to no growth budgeted over a prior year, is there a difference in how companies manage that for the bonus and the LTIP?
Well, the bonus is always a bit different, isn't it? Because you're only looking 1 year ahead, so you don't have as much of a long-term trajectory to worry about. You're more just thinking, well, what is it that we're planning to do for this particular year ahead? And that for each company, that will be, it might be up when 1 year, might be down. You go with your budgeting process, and as I described before, I think it's probably more of a challenge on the long term, because you have to be then showing a downward long-term trajectory, which I think the most important thing is that for that to be consistent with how you're talking to the market about the prospects for the business. It's no good to sort of be pretending that you're on a growth trajectory when actually you're not. That's just going to cause you and the committee a real challenge. I think probably one of the things that's happened on the way that the targets are calibrated for the LTIP is that there's been, and Alex talked about it, there's been this move away from showing your LTIP EPS targets as percentage growth, which is very difficult if those percentages are negative because you're on a downward trajectory. I think there's been a trend towards showing them as pence targets instead, which is, all those approaches have their own set of pros and cons. I think that if you're in a downward trajectory, showing them as pence can be a bit easier from a communication perspective. I mean, it can actually be just easier and simpler with everyone, with your shareholders and with your participants, to just be able to say, look, 3 years' time, we need to hit X pence or Y pence for vesting, then have to do this calculation of a growth rate from a base year, which is an extra step in the process. So I think that's probably one of the things we've seen from companies experiencing that kind of situation.
So just on the Q&A and chat, I think that actually wraps it up. And
okay.
I'm sorry if I've missed anything, but
well, I think we'll have the record, so if there is anything we've missed, we'll follow up separately. And as I say, we'll send a recording and the slides. If any other questions come up, then please get in touch. If you're interested in any sort of specific cuts of the data for your peer group or your sector or anything like that, then we're happy to provide that. So thanks for joining again today, and we look forward to seeing you next time. Have a good day.